Hey, welcome back, everybody, to the Today's Market Explained, a four-star podcast and media series. I'm Brian Castle, your host, and I'm here with my regular co-host, Mr. Chris Reardon. Chris, are you there?
I'm there. Good afternoon, everyone, and glad to be on and talk a little bit about the markets.
Excellent. Well, we're going to do our standard update today on the 7th of March, and we've had a very, very interesting year to begin the year. We saw a big market rally and then a big sell-off. And Chris, where do we stand on the positioning of the market today?
Yeah, so international equities is still holding that number one position. It's at 249 tally points and actually gained 4 tally points since the last podcast. So we continue to see international equities maintain that strength in the number one position. Cash, on the other hand, in the number two position has remained relatively flat. It lost 1 point since the last podcast. It's at 207 now. So there's a pretty big difference now between the 1 and 2 positioning that's formed there. And then in third is domestic equities. It's at 197, and it was unchanged or flat as well. And so, in that 2 and 3 position, what we're seeing between cash and domestic equities is we could potentially see a flip there, or we could see domestic equities fade or just, hold here. So that 2 and 3 position are relatively close, though. In the fourth position, we have commodities, and that's at 175 tally points, and actually gained 4 points from our last podcast. So we're seeing commodities re-strengthen slightly on that fourth position. And then fifth is fixed income at 137 tally points, -5 from the last podcast. And then in last place still is currencies, and that's at 124 tally points and -1. So not a whole lot of change. I think the most interesting thing to note would be in that number 2 and 3 position. Could we potentially see a switch there or not? That'll be interesting to see. And then obviously, I think commodities, if we continue to see strength out of commodities as well, that would be interesting.
Yes. So not a lot of change, although we did see a big rally, short squeeze rally at the beginning of the year, Chris, and then we've seen a sell-off. Now, everyone was expecting that sell-off to continue. Then there were lots of discussions about short squeezes. And so that's kind of where we sit right now. But international equities are still in charge. Domestic equities are not far behind in the number 3 spot, close to number 2. And commodities are gaining again with oil moving, right?
Mm-hmm. Correct. Yeah, more oil where it's getting at least a little bit of a short-term bump here. A lot of it's based off of China and potential reopening scenarios there. So we're seeing a little bit of a bump in oil again now.
Right. So like we said, we started the year this year with a decided rally where even the S&P was up about 10% and the NASDAQ was up about 13% at one point. So now lots of hedge funds are dumping stock. Then about a week ago, there was a talk of another short squeeze. And a short squeeze, of course, is when there are short sellers who are worried about getting caught if the market were to go higher because they lose money when the market goes higher. So then they have to buy back, and that's the squeeze, right? So the short squeeze means the market rallies. That's what happened in January. Everyone believes that was a short squeeze. So there's talk of that again today. But the Fed, Chairman Powell came out today and said, oh, no, we're going to be raising rates, and we're going to raise rates maybe even sharper and quicker. And Chris, I have to tell you, I don't think I've heard Chairman Powell change his tune one bit. Have you?
No, I don't think they've been relatively transparent, making sure to tell everyone that they're going to stay the course. I think you just have people in the market that are trying to think they're smarter than everyone, trying to make bets and thinking that he's going to relent or something's going to change and maybe he's just posturing. So it's been interesting.
So the Fed keeps saying the same thing, but then there's weeks or maybe a month or so between conversations. So every time there's a gap of time there, people start assuming the markets are going to go higher. And of course, now they come out today again and say they're going to raise rates even faster. In our last podcast, we talked about how the Fed said they might go to 5.5% to 6%. There's a Fed tool where you can see the expectation built into the market pricing. And it's saying right now about 6.25% will be the terminal rate, meaning that's where the cycle ends on the high side. And then maybe interest rates will fade from there. And that's the Fed funds rate, which is the only rate that they control. So if there's going to be a short squeeze, it's not happening today, and markets are all down 1%. But in checking with my traders, they still think there's going to be a short squeeze, but now it's just going to be a little bit delayed until we get past the Fed chairman's comments. But there's still going to be another short squeeze, as there are a lot of people who took short positions in this downturn when things turned down. So for most investors, this is all inside baseball and probably not worth dealing with. As professional managers, we always have to deal with that to some extent. But we're clearly still, Chris, in a bear market. We have bottomed so far in October. And so we're not sure. And I've said this many times on this podcast. You're never really sure that the market had bottomed for many, many months after it's bottomed. So here we are in March, and we're not sure whether the October bottom was the final bottom. You were pretty sure in 2009. We were pretty sure 2020 when the market bottomed, but we're not sure right now. And if the Fed's going to keep raising rates, and the economy is not going to go get better if the Fed's raising rates, and the market's not going to go up a lot while the Fed's raising rates. So if they keep doing that, then all bets are off, right? We could go lower, break the October lows, go lower, and so that's why we're being very defensive. But in the short run, yeah, there could be a short squeeze, and the market could rally, but then it could go lower. So when the Fed finally signals they're going to stop raising rates, well, then the market probably will bottom right around then.
Yeah. I mean, I think that, and I think it's important to note that, and we don't know, I don't think anyone knows besides maybe the people, the federal chairman himself. But, they're just taking, I think, month by month, quarter by quarter. So, there's a lot of variables on this. Obviously, we got a lot of geopolitical issues out there. There's a lot of things that people could think that they have it all figured out. And, all of a sudden something goes off in Ukraine or something, and that changes the whole equation. So we really don't know. But I think it's important to note, like you said, Brian, all we can do is follow along with what they're, mentioning as they come out. They've been relatively transparent so far. So if you kind of just take them at their word there, it'll give us a good indication as when the markets might start to bottom.
Absolutely. Well, and the markets will bottom when there's a sense that the economy is going to get better. And the economy usually doesn't get better for 6 months after the market's bottom, but the market's signaling that. So, but the problem right now is the Fed is going to keep raising rates if the economy is better. So we're in the situation, Chris, where good news is bad news, because if the good news comes out, the Fed wants the economy to slow down, inflation to slow down. And so that's why good news is bad news right now. And hopefully there will come a time again when good news is actually good news, but not right now. So Chris, tell us about what's going on. We got some metrics on the economy.
Yep. So in the housing market, we got a couple numbers to kind of wrap up last year. So the S&P CoreLogic National Home Price Index rose 5.8% on an annual basis in December. And that was down from the annual rate of 7.6% in November. So we continue to see home prices decline month over month. Home prices were slowing. So the housing market continued to slow. And on top of that, existing home sales dropped 17.8% in the total year of 2022. And that was the lowest level since 2014. So, it's really interesting because I think people already forget, but a year ago today, the first half or the first quarter really was still a very strong housing market. Rates hadn't risen yet. January, February, certainly. It wasn't really until you got to March, April, May that the rates started, taking effect. And you almost had what you're kind of talking about, Brian. You almost had like a short squeeze really there in the housing market as people just rushed to kind of buy a house to get in before rates were too high. So you had kind of that run right there. And then it wasn't really till June or July you really had things level out and really start to slow down. So that drop of 17.8% was mostly reflected in the second half of the year.
So if the whole year was down 17, but the first 4 months or so were up, that means the second half or so was really bad to get it to 17. Okay, well, go ahead, Chris.
So, and then the personal consumption expenditures price index, which is the index that the Federal Reserve really looks at to try to gauge inflation, came in at 5.4% in January. So still relatively high, if you guys remember, and they have reiterated this, their target is 2% still. So That's still elevated. The core index, which excludes food and energy, was at 4.7%. So that's still really high. And that's a good indication that there is still a lot of systematic inflation there. It's not just high gas prices or food costs, which we know does have a large impact. The CPI, Consumer Price Index, is another gauge people look at. That came in at 6.4% in January, and the December read was 6.5%. So, what we're really seeing is this deceleration of the decline, really. So we're seeing that kind of flatten out, which is a bad sign potentially that inflation is either moving back upwards or it's kind of re-strengthening in certain areas again. So it'll be interesting to see how the Fed kind of looks at that. Brian, do you want to add anything?
Yeah, and I think there's a sense now that inflation will reaccelerate. The conditions that led us here are still here, with oil prices going up again. You're going to mention a little bit about PPI. So with inflation not going down, the administration keeps saying, "Oh, inflation's under control." It's clearly not under control. That's a political statement, not a factual statement. So and that is why the Fed chief keeps saying, "We're going forward here, folks, and we're going to keep raising rates."
Mm-hmm. Yeah, and to kind of go off what you had mentioned, Brian, the producers price index, which, we look at the producers price index is a good, I would say, look forward at what inflation might be, because this is obviously what the people building the goods have to take in. So they're going to pass that on, most of that on to the consumer. That rose 6% in January, which was down from 6.5% in December. But once again, still just a slowing deceleration there, and potentially, rising again. Inflation coming back. So wages and salaries grew 0.9% in January. That's more than twice as fast as they grew in December. A lot of that has to do with some uniquenesses, I would say, like annual raises kicking in January. There are minimum wage increases for states that implemented new laws take into effect there. So, but I mean, even factoring that in, that's still a very high read, which does show, in certain areas, I think the job market is very tight still, which is, I think, still propping up a little bit of the economy, especially in certain areas. We've talked on this podcast about travel is still very hot right now. A lot of people still want to travel. Hotels are, still, it's really hard to find hotels in certain areas, and they cost a lot more. So there are very hot parts of the U.S. market, I believe, still our economy, and there are areas that are slowing. I think one of the biggest surprises that came out, the U.S. retail spending rose 3% in January. So we continue to see the consumer be strong, which is very important. And the Fed, I'm sure, is looking at that as they continue to raise rates, because as long as the consumer in the U.S. remains strong, that's a good sign overall for the economy, because the U.S. consumer is a very, very large part of the U.S. economy, obviously. And then the last thing I'll mention is the U.S. Chicago PMI, Purchasing Managers Index, slid to 43.6 in February, which came in much weaker than expected. So it's this, I think, to sum up, it's really this kind of, I would say, topsy-turvy market. On one end, you have the housing market, which, as expected, is starting to slow. We are seeing certain sectors, certain markets slow. The other end, you have, spending is still looking good. Wages and salaries still continue to grow. So you have really two forces pushing on inflation, right? You have housing prices pushing it down, but then you have, wages, bringing it up. People are spending, are willing to spend, even with food costing more, pushing it up. So we're really in this equilibrium kind of Goldilocks type market, I would say.
It's interesting, Chris. Plus, the leading indicators, leading economic indicators, which is an amalgam of different indicators together, are down now 10 months in a row. We've never had a period of time where we've seen 10 months in a row and not had a recession. So now many people, of course, feel we had a recession last year, even though there were two positive quarters. The underlying shows a recession in the U.S., but now everyone believes that the Fed will sink the economy into a recession to save the inflation from ravaging the economy, which could be even worse. So, so we're looking for a recession here, most likely, but maybe the markets will figure that out quickly and discount that, and we don't go a lot lower. So time will only tell how the markets react to that. So thanks, Chris, for the report. There's some new patterns emerging in retail sales. Chris talked about how retail sales were strong. And it used to be that retail sales would accelerate for the holiday season in November and December. And now for the third year in a row, that pattern is changing. So instead of accelerating in November and December and then crashing in January, now consumers are buying early in October to avoid chasing high prices in the holiday season, then buying in accelerating fashion in January. So it's happened now 3 years in a row. So maybe things are changing there, Chris. It's quite interesting.
Sure.
Yeah. And so anyway, that's enough on our economy. I will mention that part of the reason why there's different cross currents in this economy is that, not all the world's economies have recovered in the same fashion. Europe is a little bit behind, 6 months behind America as far as recovery. And China has been locked down for most of the last 3 years. So there's a lot of pent up spending. And so that's reflected in the shares of stocks in China. The markets have been very rough, and now they're moving up. Now, we've uncovered a lot of issues with China and China-U.S. relations. And, a lot of people are very scared. We've got Chinese balloons flying through our air, doing surveillance. And clearly, China is getting very, very aggressive and trying to take world leadership away from America. So it's a little scary. But the stocks are going up. So as long as the stocks are going up, investors can make money in Chinese stocks by trading Chinese stocks that are listed on American exchanges. And of course, you're not stuck there forever. You can always sell those shares if you want to. But right now, there does seem to be an opportunity in Chinese stocks. But the good news is the Biden administration, although they seem to be lighter on China than the previous administration, they have had meetings to move manufacturing over to other countries like India or the ASEAN region. Cambodia, Laos, all those countries, Vietnam, and get out of China. One of the presidential candidates announced, our former president, Donald Trump, has said if he's elected, he will move to end all of our manufacturing in China and go to other countries that are more favorable to America. So that trend is happening, but question is how quickly does it happen? And does a lot of things happen in the meantime. So we'll see what happens there, Chris. So let's move on to the general what we see out there, Chris. I know we're talking about apartment rents are falling and a bunch of other things.
Yep. So we're starting to finally see apartment rents fall. So renters with new leases in January or to start 2023 paid a median rent price that was 3.5% lower than what they paid in August of 2022. So it's a little over a quarter there, and already a 3.5% drop in prices is a good sign. I mean, obviously the housing market's been tough, and that's with the housing market being tough to purchase. A lot of people have been forced to rent. And so seeing those fall, I think, is a good sign that hopefully frees up, consumers and people to be able to go spend more or save money to purchase a house. The other thing we're kind of seeing out there with the recent news of the Fed continuing to move forward, we're starting to see the dollar strengthen again. It's strengthening for the first time since September, which was the last time really the market started kind of to discount the fact that the Fed they knew the Fed was going to raise, certainly, but they started to discount the fact that they thought they were going to stop. And I think the projection was as early as May of this year. So we started to see the dollar weaken based off of that, because projections were maybe a Fed stopping raising rates or halting in May. Now that the market is kind of digesting the new information and the new speculation that the Fed is going to raise potentially more or even continue to raise higher rates, we're starting to see that dollar re-strengthen. So that has a lot of implications, especially on the U.S. economy, U.S. markets, and the global markets. So that we could see that coming down the pipeline. Lithium prices. So lithium, if you go back a year or two, was really a hot, kind of the hot word, if you will, because lithium is a large component for electric vehicles, things like that. So Tesla was obviously a hot stock. A lot of people looked at lithium miners trying to get kind of an inside track. Instead of buying Tesla, which had already gone up 1,000%, they thought they could get lithium and almost get exposure as a derivative there. So lithium prices, though, plummeted as of late as supply has far outpaced demand. In fact, lithium is projected to be worth just $34,000 a ton this next year, compared to an average of $53,000 a ton this year. So potential huge drop in lithium prices. And then the last couple of things I'll mention, Pfizer right now, obviously the company that has been, I think, on everyone's mind since the COVID pandemic and everything, they're in preliminary talks to acquire Seagen. So Seagen is known for their targeted cancer therapies. So they're looking to acquire and expand their health aspects. So Intel, and then Intel released a software platform that is targeted for quantum computing developers. So this would allow developers to build quantum algorithms to eventually run on quantum computers. This is huge. I mean, this is gonna, when eventually quantum computers come out, which it's not an if, I believe it is a when. It's going to change everything. I mean, if you imagine the stock market, there's a lot of, these computers can process things 10 times plus, millions of times faster than our standard computers. So it'll be really interesting. The fact that they're rolling out this developing platform shows that, they are close, and that is something coming in the next 10 years or so. And then the last thing I'll mention is Amazon just rolled out a new program to allow workers to be able to use stock as collateral for homes. So under this arrangement with Better.com, Amazon workers will be able to pledge their shares for loans for down payments instead of having to come up with 20%, or they can pledge their shares and this company will take that and call that for their down payment. So interesting there. I think some of this is to allow for, as Amazon and a lot of the tech companies have cut jobs and even lowered salaries there, it's been one of the sectors that has been hit. I think it's to still allow their employees to afford, in some places like San Francisco, Seattle, these astronomical home prices. It allows them to kind of still be able to somewhat compete there for homes.
Yes. Interesting. Thank you, Chris. You mentioned the thing about pharmaceuticals. It might be tough for pharmaceuticals going forward because, they had so much cash flow from the government buying all the vaccines, and that was really so much of a driver of their earnings the last couple of years. But now they have all that cash and they're using it, as you mentioned, to buy companies, and there's not as much COVID spending. But now there's coming more and more releases with the Twitter files and things like that, that there was some understanding that the vaccines weren't as safe as they claimed, as some of our leaders claimed. So there could be some major issues with the pharmaceutical companies. They were given immunity, and they kind of ran a truck through that immunity because now it turns out that many of the vaccines weren't near as safe. There's many people with heart trouble and other things. So we'll see how that plays out. It might be tough going for the pharmaceuticals. Chris, I wanted to comment on this whole subject of FTX. We've been pretty silent on this subject. And, everyone knows we've had discussions about cryptocurrencies on our podcast for many years. I'm an owner of Bitcoin, for full disclosure, and we bought it in 2017. So it's up dramatically from where it was at 1,200 a unit, I believe it was when I got in, went to 64,000 a unit. So it was a big win, but now it's come down. But now with this FTX bankruptcy and Sam Bankman-Fried, it's really become a bit of a mess. Looking at this whole situation, Sam Bankman-Fried, or SBF as they're calling him, his girlfriend ran the Alameda Trading Company that did a lot of the trading, but now she's pleaded guilty and detailed how she and SBF conjured up false financial reports. Now, it's complicated because they are headquartered in the Bahamas. So it's only a matter of time before SBF, the innocent plea fades, as he probably agrees to cooperation to minimize any jail time. Basically it looks like they operated that company as a personal piggy bank. He owns 10 homes. He's the second largest donor to one of the political parties. And in fact, they even masked more donations to the political parties, even more than what was believed. So they broke election laws there as well, allegedly. They created straw man donors to mask that. So he's engaged in even witness tampering in his recent indictment where they're doing testimony, and he's trying to contact witnesses through some encrypted format. So it's really a bit of a mess. It's going to roil the crypto markets for a long time. And the one big red flag, as I mentioned, is that they operate out of the Bahamas. I think they knew they were going to do something like this because the rules are a little loose out there, right? So anyway, no U.S. protections. And then also the SBF has been writing on Substack. He's been opining on Twitter and all these crazy strategies for someone who's going to be going into a trial. It's going to be pretty hard for the defendant lawyers to protect him. The prosecutor is going to have a field day. So it's hard to believe that this guy is plausibly innocent. But nonetheless, we always caution folks, if you get involved in something like Bitcoin or something very, very risky, it's got to be with only money that you can afford to lose. And no one should bet their whole life on something like this that is somewhat untested, because it is a crapshoot. There's no doubt about it. So.
Yeah, no, I would agree. I mean, I think it's highly speculation. I mean, if you're going to put something in that, you might as well. It's the same thing as going to Las Vegas and putting it all on red or black. You could make a lot, but you could just as easily lose a lot.
Exactly. Couple other comments. President Biden has proposed to extend the halt of student loan payments for another year, and that would cost, according to the scoring, about $400 billion. And so we wanted to comment on that. We've been on pause for student loan payments since the pandemic, March of 20, but the pandemic's over, and so many are wondering why he's doing this. And I'll leave that to the listener to figure that out. Clearly, when you give people money, they're favorable to you, so that could be the reason, I guess. Maybe you can come up with another reason, but clearly the economy is slowing, but it did recover. So people do have a lot of cash. They are able to make their payments. Unemployment is low. So most people should be able to make their payments. So it seems unnecessary to do that. So we're not a fan of that idea. I did want to comment also on a really interesting story that we heard about. We talk all the time about capitalism versus other forms of government, and our economic system that's created the most prosperity of any economic system in world history. We talk about socialism and communism. Well, a lady named Yeoman Park, who is an author, lives in New York. She was born in North Korea. She escaped with her mother to China, and then the Chinese sold her mother into sex slavery. So she had, as a teenager, to escape from China through Mongolia. And many folks don't realize that Mongolia is a capitalist country. So it's not quite like America, but they're trying to mirror the success of the capitalist system of America. And she got through to South Korea. Now she's at Columbia University. And since she lived under communism and went through all the ravages of the communist system, she says she's very scared for America. In her recent book, folks at Columbia support socialism and equity and inclusion without really any thought to what it could do. They're willing to break the whole country just for socialism and communism, which makes no sense. So the folks that we need another example, the folks that understand the benefits of freedom, liberty, capitalism, and all the things that our freedoms bring us, the ones who understand it the best, who are the ones that lived under tyranny. So once again, we have a Yeoman Park, an author who wrote a book about that and has been appearing on a lot of different shows. So we have a lot of folks in Chicago who are Chinese, and those are the folks that will also say, hey, be glad you're here. Don't live under communism or socialism in any way. So I just wanted to point that out. We got another example of that. And last thing I just wanted to comment on, we saw some interesting reports on the best states for minimizing taxes in retirement. So let me name those states: Alaska, Florida, Georgia, Mississippi, Nevada, South Dakota, and Wyoming. And the three worst states for retirement minimizing taxes are Illinois, California, and New Jersey. No surprise there. Now, I recently took a trip to California on business, and when you're not there for a while, it's easy to listen to the national media and get all negative on California, but it is a beautiful state, and there's so much to like about California. But all this is just purely about policy, folks. It's about what states tax their people too much. They keep taxing and keep taxing. They raise taxes again, and they have policies that drive people out. So the state may be beautiful. I believe Illinois, where we live, is beautiful, but the tax policies are driving people out of our states. into the states where the tax policies are more favorable. So we'll probably continue to see that shift until things change, until some states change their stripes. So anyway, that's our report for today. Chris, in the leadership matrix, we did have a few blog posts. We put out a piece about changing taxes. There's a move afoot to get rid of income taxes, believe it or not, and move to value-added taxes and retail taxes like they have in Europe. But I smell a rat. I think they're going to add the retail taxes and not get rid of the income taxes, Chris. But we'll see. But we put an article out on the leadership matrix about that, just the story of what they're considering. So have a look at that. And then also on the 4-Star website and the leadership matrix, we put out an article about how it's time to relearn how to shake hands and work a room. So we've been under pandemic rules for a couple of years, and seems like a lot of people haven't really had business meetings and gone to breakfasts and lunches and conferences and things like that. So we put out a piece that talks a little bit about how to do that. It's time to go shake hands, go meet people, hug people, all the things that that normally happen when people get together, Chris. So it's time to get personal again, I guess, right?
Yeah, that's exactly right.
And then the last one on the leadership matrix I wanted to point out is we put out a piece about 3D printing. The 3D printing is obviously where you have a computer that then sends a design of a 3D object to a printer that actually creates it. You might remember, folks might remember going to a museum and getting those little plastic figurines and molds that are made, and that's kind of like early gen 3D printing. But this is the kind of stuff they're talking about. They can actually make machines from a computer into a 3D printer. It's not a plastic figurine. It's actually a machine or something much more useful than that. But now they've got the compression technology that they can do 3D printing across country. You can send to a printer anywhere in the country. It was hard to do that before. So I have an interview. It's a venture capitalist from University of Chicago who's involved in it, and very, very impressive. The company is called Mark Forged, is the company that's doing most of this work. And then lastly, Chris, we did have a podcast interview that came out with a venture capitalist from New York City. And we wanted to just get an update on that whole subject. What's the state of the venture capital market out there? Venture capital is part of the early stage formation for companies before they come public, if they ever do. And so it's important that all those parts of capital formation work in an economic environment, whether it be early stage investing, venture capital, all the way to public markets. So let's have a listen to that interview if you would too. So Chris, that's a mouthful. I think we're done. Why don't we leave it there, huh?
Sounds good. Yeah, I think that's about all.
All right. Well, thanks everybody. Thanks folks for our whole 4-Star team: Laura, Chris, Christine, Fred, Jack, and Jonathan in Chicago, and our East Coast team of Tucker, Brian, and Karen. Thanks for being with us today on the 4-Star podcast. Don't forget to give us a 5 out of 5. Tell your friends send your friend a copy of our podcast and help us get more and more listeners. Thanks, everybody. We will leave it there. Back shortly with a new episode. Bye-bye for now.